Hi, I'm Jim Mendelson, a managing director and co-founder of MGI Research. Today, it's my pleasure to have with me Terry Tillman, a managing director in equity research at Truist Securities. Terry has a long tenure on Wall Street, and we've known each other for close to 20 years when he worked at my old firm, Soundview Technology Group, with me as part of a team covering the software universe. Today, Terry is one of the leading analysts following the application software and SaaS sector. And I hope that all of you have had a chance to see Terry's presentation, A View from Wall Street, which provides an excellent set of insights into how the street evaluates these businesses. Terry, thank you for joining us.
Thanks for having me.
First, why don't we start with just giving a little bit of an outline on how you describe your coverage universe and how do you segment it?
Absolutely. But let me say a few things first. Happy New Year, Jim.
Thank you.
Seeing you. I can't wait to see you in person again. And thanks for letting me participate. Yeah, as you said it, I cover application software and SaaS companies at Truist Securities. I actually have a colleague that covers infrastructure software, and that includes cybersecurity. So we've kind of bifurcated the coverage landscape. And there is actually a lot to cover in software. I mean, compared to a couple of years ago before we saw just such a big proliferation of SaaS companies and going public, it was more of a confined kind of coverage area, but now you could cover a lot of names. There's probably 150 plus publicly traded software companies now. But yeah, we kind of segmented between applications and infrastructure. And the way I would look at my names, I cover 24 names. I have two senior teammates that work with me. One way to look at it is market capitalization. So that relates to just the value of the company based on the market cap. And one way to look at it is I cover a couple of names that would be considered mega cap companies, and that would be Salesforce, which I'm sure everybody knows, as well as Shopify. So mega cap defined as, this is 100 billion or a couple $100 billion market caps. And then I cover probably the bigger sweet spot would be small and mid cap names, a lot of which are in that $5 to $25 billion range. And what you'll notice in application software, you do have a lot of fragmentation, a lot of niche software companies, great businesses, but smaller in terms of compared to, the internet giants and large cloud compute companies. But yeah, one way is market capitalization. And then the last thing I would say, another way to kind of look at my universe are software companies that are more horizontal focused, whereby whether it's a front office tool, middle office, or back office, it's really applicable across all industries and even sizes of business. And then there's vertical focused software companies. So that's another way to, kind of segment my coverage is horizontal versus vertical software companies.
When you look at 2020, which obviously was a horrific year given the crisis with COVID, but one of the big side effects has been the dramatic acceleration in the trend of digital transformation of business. And that, combined with the record low interest rate environment that we've had, has been driving valuations and stock prices of these cloud computing application vendors to record highs. And I guess, from a big picture point of view, very simply put, do you think there's still room to appreciate? Can these valuations be sustained? Are these companies growing fast enough that they can continue to appreciate?
Sure. Good question. I'm inherently an optimist. So I'm going to say yes, 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 and yes to, however many multi-parts there were to that question. First and foremost, fundamentals are really important before you start trying to handicap what's going to happen to stocks and the future outlook for stock performance. And going into 2020, yes, digital transformation, it's a kind of widely used phrase. Frankly, it's probably overused, but there is no question, over the last decade plus, the acceptance of cloud computing at a high level has been playing out. And then when you start looking at just all the innovation of these interesting SaaS companies, whether they are horizontal, line of business, broad-based, really digitizing a lot for an organization, or vertical software companies, we have really been seeing a renaissance here in terms of lots of adoption now. Sometimes it's greenfield, sometimes it's replacing legacy applications. But going into 20, I had so many companies that were regularly growing over 30%, some 50, 60% or even higher on large revenue basis. So going into the year, there was a ton of momentum with all these secular dynamics around digital transformation. And then, COVID hit. The stock prices initially had a violent reaction to the downside. I think what we learned in 20 is this by no means is a fad, and it really probably accelerated businesses, government entities, the public sector, and businesses from small business up to large enterprises that, hey, they were on a journey to transform digitally. It's accelerated. So the way they engage with customers, I mean, customers had to go online. Banks, you couldn't go on bank branches. You would need to schedule a video call to do your banking. And it inherently just, I think, quickened the pace towards digital interactions. And at the same time, also employees and continuity for businesses. If you were investing in collaboration or communication tools that are cloud-based, you had to quicken that pace as well. So I think fundamentals ended up being extremely resilient. In some cases, there was an increased pace of investment. And yes, that ultimately then led to what you were asking about, which is the stocks. It was a tremendous year for stocks. I mean, going into the year, we had a report called the Roaring 20s. Mm-hmm. It was even well in excess of what our bullish optimism was for stock performance. And there were some other kind of contributing factors. You talked about low interest rates, kind of where would you invest in a low interest rate environment and where do you find returns? But no question, the high growth nature of our companies played out. But yeah, the stock performance, for some context here, as I said, we covered 24 companies. 11 of our 24 companies were up over 100% for the year. We only had one stock out of 24 that was down, and that was really a company-specific issue around a cyber security breach late in the year. Otherwise, it was up.
I think I know that name, Terry.
Yeah. So there was broad-based stock performance, and yeah, I think the goodness just continued, and in some instances, there was even accelerating trends. The one thing I should say, though, look, not all companies are created equal or saw incremental benefits like video communications or cloud communication software or other types of productivity tools when you're working from home. There were some areas that were a little bit more discretionary, and there was an impact. But you know what the reality was? Even in cases where it's more of a nice to have, you're talking about renting a piece of software. It's not a big capital investment. And there was still some dynamism and some reasonably good demand for all of my companies. In fact, most all of my companies, they grew their bookings year over year. Who would have ever thought that in a pandemic, a generational event that software companies, even average wins or slower growth wins, would still be booking more business than the prior year. Now on valuation, because I've been trying to kind of hold off on trying to answer that extremely tough question. I think you're trying to ask me, are we at a top?
I haven't gotten there yet, almost.
Yeah. But in terms of valuations, going forward, I would suspect, yes, over the last 3 or 4 years, we've had structural increase in valuations, and valuation really in software is around sales. People look at sales multiples when they're looking at these software companies, because the idea is in such a high growth market, you have to invest to monetize. Earnings and cash flow are important, but in the years where growth is strong, you actually don't make much money in that first year because of the revenue recognition, but there's a real kind of thirst and appetite for growth. So people look at sales multiples. And yeah, high growth companies, we've gotten into regularly seeing 20 to 30 times multiples. I'm not, it's too hard of an endeavor to try to say, hey, 27 times sales is ridiculous and it should be 20 times. I'm working within the framework we've had, which is the investor appetite for software has continued to pick up quite a bit. There is tremendous growth going on with most all of my companies. And we have some very large TAMs playing out. So what I try to do is within the world we're living in, which is rich valuations, looking at these themes and picking companies that, the tailwinds should be sustainable and they can sustain growth for many years while showing leverage in the, further out. But the reality is those high growth companies that I call compounders, whether you're buying it today and would you say, well, maybe am I buying it too expensive a level? Should I wait? But in the end, I do believe that high growth companies with sustained strong growth, they're going to be great stocks over time. And but again, in terms of where we go on valuation, it's tough to call. But look, I'm talking to investors all day long. And right now there's an ongoing thirst for the types of companies I'm covering in the industry I'm looking at.
Kind of following up on this theme here, there's little debate that one of the big impacts of COVID was that it caused this acceleration. And I guess one of the related questions is, hopefully we will see COVID somewhat tamed in 2021. And to what extent do you think that that represents in any way, shape, or form kind of a visible risk to the projected growth rates? And I don't mean it in the sense that growth suddenly stops or, but just that it moderates a little bit. And to what extent does that collide with valuation? And I guess, one of the things related to this is kind of the idea of, are we in much danger of a bubble like what we had in the tech bubble of 2000? Kind of what kinds of things would you highlight as distinctions?
Yeah, well, let me answer that bubble. That's I don't like that word bubble. So that's
none of us do.
Let me take that word quickly and try to take that off the table, or let's move past that conversation. But it's also a good question about, the momentum we've seen with some companies in certain sectors. Is there now headwinds? But on the concept of a bubble, I begun my career in the late 90s. So I did see some of what had happened in that late 90s, early 2000 timeframe. What I would say is nowadays, a lot of these software companies, they're well proven before they're going public. You've got very sophisticated investors, very smart investors. I think by the time these are late stage private companies, the addressable market has been proven out. Their positioning in that market has been proven out. They're also leveraging lots of SaaS tools to even build their business. And we're talking very data-driven companies. So I think, nothing against that time frame, but I think a lot of these companies, these markets are real. They're not aspirational, they're real. And they're very proven companies. And when you look at things like unit economics, LTV to CAC, and I'm impressed with the maturity of these companies when they're private. And I think it also speaks to these addressable markets are real. And where we are 20 years removed from that time frame, it's clear as can be. Software itself and technology is increasingly a much bigger and bigger piece of the economy. And so as you see more and more things get digitized, and we're not just talking cloud computing, we're talking now about edge computing, we're talking about lots of things going on. The more software surrounds the world and the economy, no, I don't think we're in a bubble. I mean, we could have arguments about valuation, which I think I'm never going to argue with you, by the way, Jim.
But we're not arguing. I'm playing, you realize I'm playing devil's advocate a little bit. I agree with what you're saying.
Yeah. But it's, the business models and these end markets are tremendous. So I'm not concerned about a bubble per se from that angle. Now, it's a great question, though. These stocks did have big years. As I said earlier, I had a lot of stocks that more than doubled. I have one stock, Coupa, COUP is the ticker. It's had 3 years in a row of 100% plus return. And so, so yes, there's been a lot of this momentum reflected. Look, here's the first thing, though. The idea of work from home or work from anywhere, the idea of, kind of reimagining work. Look, some of this was, episodic related to we need to do something now to repurpose people at home. But I think there's structural dynamics here that are going to stay in place. Look, some of us will go back to the office, but I think we've got a long tail to some of these trends around the work from anywhere environment. And, enabling that and rewiring the way we work, that's multi-year though. So yes, we've seen some near-term benefits, companies like Zoom and RingCentral and Five9, where they saw tremendous order taking, so to speak. Mm-hmm. But the first thing I would say is, I don't think all of a sudden it was a Y2K event. And then we have a hangover from that. This has just sparked what I think probably was going to occur with just certain generations of the workforce. I look at my kids, that this has just hastened the pace, and it's a multi-year technology rewiring or new investment in these productivity tools, collaboration, and communication tools. The other thing I would say, though, even if there was a little bit more of, hey, we've got just a couple of years of really strong kind of uplift because we need to buy a bunch of things to kind of help reimagine that work. I think the other thing is the estimates, though, are not aggressive. Street estimates, and that street means myself and other analysts, it's called the street. the thing is, when COVID started playing out, even for our highest growth companies, people really did tame their models and their assumptions. And so, yes, as we moved through 20, we started, recalibrating our models and getting more optimistic. But I have to say, most importantly, beyond just, I would disagree with somebody that says this was just a kind of a flash in the pan kind of spending and frenzied spending. The numbers are actually, I think, conservative, even for my highest growth, highest valuation names in 21 and beyond. And I think that's important.
Having lived through the past, I can agree with you 100% that there are enormous differences between what we saw in the past in terms of valuations and the problems that we had back then than what we're seeing today. And I'm very, very optimistic and share your optimism on that. Can we talk a little bit about how you go about picking a stock or embarking on a new research effort?
Yeah, and everybody has a different process. There's no one right way. For my background, just so folks would get a sense on, because we all come from different backgrounds. You have some people that were programmers, they knew technology, they were coders. That wasn't me. I was a finance major, and so and in fact, I didn't start in software. But the way I've come about it over time. So for me, this idea of voice of customer. So one of the things I want to do, I don't go into something, hey, I really am just focused on big companies, large markets, and really large revenue companies, and that's my focus. For me, I have really an open mind to, they could be niche companies that may never be multi-billion-dollar companies, but look, they could have 80% market share in that little niche. That could be a pretty darn good company. But at the same time, you could have big companies serving really large global markets. So I don't really have a certain penchant for it's got to be big or bust, or I'm really just focused on little ones. I really, depending on the situation, I can come at it from, it could be a totally different story than the next story. But the first thing I try to do in my foundation is, beyond reading things like S1s and 10Ks, which frankly, sometimes you don't still necessarily know, what does this software company do? Mm-hmm. What we start to do in the process is actually talk to users, practitioners. So whether they're people in finance that would use SaaS tools, whether it's people in marketing that are trying to drive prospects and demand generation, whether it's bankers that are trying to automate the loan underwriting process. One of the things that we do is a foundational element is talk to the users. What happened? Why did you feel the need to go to market and go try to buy one of these SaaS solutions? What was the catalyst? So then when you were going through that process, what stood out with this company? And it can be wide ranging. Sometimes it can be as simple as, well, it's a better price. Or no, there's a lot more to their technology than the other companies. But the foundation for us is we really start to try to have a broad collage of talking to users of these technologies. Now, that's hard to scale, but we do enough of it, it adds up over time. And we actually try to create repeatable relationships where we can go back to these folks and talk to them and kind of, have a life cycle to that. Because look, the tools they're buying from these vendors, if it is sticky software, it is really helping with the mission critical process, and their lives would be different if they didn't have it. Well, here's the reality. That sticky vendor is going to try to sell them more products. So we really try to have this repeatable process of understanding the buyer sentiment and the voice of them as it relates to these vendors' products. That doesn't prove or guarantee success, but in the end, what we're really trying to figure out, is this software nice to have, or is it really kind of important to the day in life of an employee? So that's one of the things we do. The second thing we try to do, and by the way, one of the ways you can do that is go to user conferences. The world's different now. It's hard to do that when you're at home. But look, we're still doing a lot of that grunt work, talking to folks, dialing and talking to them, doing video calls. But that's a key part of our process to understand, is this software company have the goods as it relates to the technology? The second thing I think that is important is, nothing's in a vacuum, and talking to people that see the industry and who's doing well and who's not. That would be either consultants or system integrators. Quite often, when you're looking at enterprise type software, they see who's doing well, who's not. And frankly, they're an influencer to say, yes, you should buy this vendor's tool. So over time, we've tried to codify, talking to these system integrators and influencers, because you know what they can help you with? They can help you with who's executing well and who's got momentum in the market. So combining, are the products strong? Is there differentiation? With also that part of like execution, and can they sell well? Those are important elements. And, it doesn't always mean it's a home run, but if you can see that, hey, this product was a lot of utility, the market is a legitimate market, it's got staying power, and we vetted that this company seems to have strong momentum according to system integrators. That's really where our foundation is, like getting into, models and how accurate our estimates are and how precise is our DCF. That's another way an analyst could differentiate. But for us, it is really trying to have that primary research of talking to customers and users and practitioners that are consultants.
So Terry, with that backdrop, who can you give us 3 or 4, however many names you'd like, but who are the current favorites among your coverage list, purely from the standpoint of fundamentals? Because I want to take the valuation issue off the table for a minute, because who knows about valuation ultimately. Which ones would you really point us toward?
Yeah, so I do have a bunch of buy-rated stocks right now, so that means I'm favorable, and that by definition means, yes, investor, I think this is a good stock to buy and own and hold. In the case of the question you're asking, part of it is the benefit, though. They went public a long while ago, and I was involved in early, and it's just been such a pattern recognition. So there's a benefit to history and just being there for a long time. But there are 3 names. So yeah, this is a question I'm going to give you an answer, actually. So that's
wow. Okay, great.
Good for you. Yeah, in the audience. So there's 3 names that they have the products. We've done all that work. Yes, there is differentiation with the product. And you can use the word moats. They have moats in their business around the technology and the innovation cycle. And then also it's been proven and validated with great market momentum. And the market itself, the visibility on them taking share either from the share donors or just the market evolution to where they will be able to have a really strong, predictable compounding growth rate for many years. It all has come together. So there's 3 names. So here, I'm finally going to answer the question. So, and it's not in necessarily one like order of best to the least of the 3, but Ring Central, the ticker's RNG. The next one is 59FIVN, and the third one is Coupa, COUP. And you said let's take valuation off the table. Yeah, all 3 of these, by the way, are not cheap stocks. Some would argue, at least in a couple of cases, they're quite expensive. But here's the deal with these 3. If you want, I could kind of run through them really quickly.
Sure.
So Coupa, they had the benefit of being more of a modern technology stack for doing procurement to pay. So that space has existed for a long time. There's lots of traditional vendors, but they came along with more of that consumerization of IT, that user experience that's really easy, abstracting a lot of the clutter on an application that you log into, just a very elegant experience. Then over time, they really hardened the application with all the bells and whistles they would need in the enterprise market. And oh, by the way, what business isn't trying to better understand all of their spending and be more efficient with all of their procurement, not just indirect and direct. So the tailwinds were there and their timing was great. And that last piece now, the large global system integrators and others really are kind of giving them the seal of approval. So they've had really strong compounding growth, over 40% for many years. And I think they can keep growing at a high rate of growth, all the while showing operating leverage, which has been nice to see. It proves out these recurring models. They grow the revenue, and at some point you really hit that economies of scale and you show inherent leverage, and they've done it. And the other thing that I like about that name, what is important for expensive stocks is what are the future deliverables and call options potentially that are on the horizon, but not necessarily moving the needle today. They've got a bunch of very interesting things that could drive upside and sustain growth for many years, particularly around like B2B payments processing. That's an area they're disrupting. 59, ticker FIVN. What is interesting in that space, they were doing cloud contact center software before cloud was really acceptable at all for something important like a contact center operation. They continued to strengthen their products, and the market did start to turn in terms of we're comfortable moving to cloud for this workload. And I think with COVID, it really accelerated the idea of, you need more modern technology, particularly when contact center agents are working remotely. And the other thing that, they've also, there's scarcity value too with them. There has been a lot of consolidation. They're one of the last companies standing and independent with scale. And it's another stock that is, not considered cheap, but that market, the shift from offline contact center software to online, it's just a really visible depiction, and they're going to win a lot of that share. And the last thing, because if you're going to justify an expensive stock, what are the upside drivers? What is going to continue to cause that upside momentum? They've got a bunch of newer things, whether it's international, whether it's a strategic relationship with AT&T, et cetera. The last one, RingCentral. Now, this one's interesting because at first, if you just do like a search online, cloud-based phone systems or PBX, you'll see a litany of companies. So some might wonder, well, what do they do that's different? I mean, we're talking a phone system. What they really cracked the code early on, in our opinion, is they really brought together all of these forms of communication on a single screen on a mobile device. And they did it very eloquently. They also were able to really have enterprise carrier grade technology, and that may be taken for granted, but what we're talking is call quality and having 5 nines of reliability. So they had the performance, but they also engineered something simple for employees and users. And so they've done very well. They've had 30% plus compounding growth for many years. And in fact, they've sustained that kind of growth after going public many years ago. And they also have a bunch of newer, I think, catalysts that can drive strong ongoing growth and upside. So that was probably more than you bargained for. That was a lot there, but I have a lot of other companies, for full disclosure, that are good buys. But those are names I would consider those like 1A names. In a market where you don't know what might happen, I believe the relative visibility, or there's no such thing as certainty, but on a relative basis, I think they're very predictable names going forward. And there's a lot to be said for that.
That's great, Terry. And for our viewers, you can go back to Terry's presentation slides and get more information about the companies that he's positive on at this point. In the remaining time that we have, I wanted to touch briefly on, the IPO outlook. 2020 turned out to be a surprisingly strong year. I believe it was a record year in terms of the number of IPOs. And I'm curious what you see looking at the 2021 for your space.
Sure. 19 actually was perking up quite nicely, and part of that. So let's go back a little further. Actually, this idea of cloud computing at a macro level, then looking at digital transformation and all these interesting SaaS companies, whether they're helping lines of business or it's horizontal or it's a vertical application for fintech. A lot of things have been coming together for a number of years. So 19 ended up being a relatively solid year for IPO activity. And really just the visibility kept improving as we were going through the year in terms of, really interesting private companies growing at high rates, having relative scale already, and what seems like large TAMs. So in 20, things shuttered. But then I think when people realize, look, not only is the idea of software and digital technology a huge mega trend that won't be kept down by something as tragic as the pandemic. But then we saw some really big snapback in terms of just the demand and people getting back to business. I think that got us back to what was already a natural situation, which is lots of interesting companies that there's a real thirst and an interest for those from an investor standpoint. So yes, the year did pick up robustly. And I would say going into 21, if you look at valuation levels and the interest by private companies to, monetize and go to the next step of being public companies and seeing advantages for being a public company, having a currency, maybe retention for employees. I think there's a lot of interest by private companies to go public and strike right now. And I think there's a lot of investor interest in interesting private companies, and yet more names to look at that could be in interesting niches in insurance or banking or e-commerce. So I think the investors continue to be quite interested in these private companies. And I think there's a real demand. And I think the private companies, the portfolio of private companies that are aspiring to go public, I think it's going to continue picking up pace in 21.
And I guess as a final
one other thing, I should say one other thing. There's also this idea of SPAC. So you're actually seeing that as another interesting angle. And there's different reasons for a SPAC. The time and the expediency and the cost. There's some people view there's some advantages with it, and also just a management team comes together with know-how and, to go out and acquire something or, find a market that they want to go, really make something happen with some interesting assets. But that's been another kind of interesting dynamic that's also playing out too. But it's all part of the idea of IPO activity picking up.
Okay. One final question. M&A. I know from your presentation you mentioned that you see 2021 as being probably a very busy year. Would you just quickly enumerate some of the drivers behind that?
Sure. Yeah. And so I think in 2020 was probably going to be a strong year, but it got impacted because, look, nobody really knew what was going to happen, whether it's the software companies, whether it's the users of these products. In general, nobody knew. So like the potential buyers and sellers, I think we had a period of kind of thawing out a quarter or two where they needed to understand what was going to happen in their business. So whether it's the companies in a position of strength that were looking to buy versus build, they kind of put the brakes on kind of their appetite. And the companies that either, were realizing maybe the best outcome is to sell their business, or they didn't think they'd be in a position where, things have changed, or, it's not as good as we thought, maybe we should put the for sale sign on. There was a lull. But I think once we started getting through and having better visibility on the degree of impact from COVID, things started picking up. And so as the year progressed, it really started to come together, in the waning months of the year in terms of more and more activity. And it really runs the gamut from strategics, buying companies, tuck-ins to even bigger acquisitions, as well as private equity firms, which are flush with cash. We've seen, these mega funds being raised by private equity firms. So I think it all kind of came together. Yeah, we started seeing the exiting the year in a strengthening M&A cycle. And look, I think IPOs will be likely a positive outlook and continuing to strengthen in 21. But also M&A, what you're going to have, I think, is, yes, a continuing strengthening as businesses just have better visibility with everything. You've got a couple other factors here that also hasten the pace. You've got companies with strong stock, which is a currency, to go do M&A. You also have access to really low cost capital. So I think everything's setting up for a big M&A year. And look, it did end on a bang. Salesforce, which is a name we cover, announcing its intent to buy Slack for $28 billion. That was a 24 times estimated sales multiple takeout price. And so that alone will be interesting, because when you see these big companies buy companies, you do sometimes see some other kind of adjacent moves and other big companies saying, hey, we need to bulk up as well. So I think it's going to be an improving year for M&A. And that's another thing that will also, I think, be supportive of valuation levels as well.
Terry, I think we're out of time, but that was great. I really appreciate your being with us and look forward to talking with you in the future. Thanks.
Likewise. Thank you.